Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional. Hello, welcome back to the Stash. We're very lucky to have our first repeat guest, Mousina, on today. Very timely to have her on as there's lots going on in the world of finance and economics. Diana is one of the best at making the game of economics approachable, easy to digest, and somewhat fun. She's spent over 15 years across markets in superannuation and economics, and she's really big on cutting through the jargon so people can make better money decisions. Today, we're going to cover off on things such as the federal budget changes, productivity here in Australia, and all things global economic and local economic conversations. I really hope you enjoy. Diana, welcome back. You're officially our first repeat guest. That's how good you were on the first occasion. For those of us that haven't come across Diana, she's the Deputy Chief Economist at AMP and building a really strong reputation for making economics somewhat fun where possible and a bit less painful than what we're used to. I think with the federal budget just being our interest rates going up and the global landscape sitting where it is, it's super timely to have you back on, Diana. So thank you so much for dialing in.
Thanks for having me again, John. It's always a pleasure to talk to you guys.
Brilliant. So, Diana, I do note that you make economics a bit fun. I was just talking to you offline before about how the team in our office love listening and hearing your reels specifically, just making it more accessible and enjoyable. And the corduroy cap you wear in your LinkedIn profile picture is cool as well. But how did you actually end up in the economic field in the first place, Diana?
To be honest, it was quite a natural, boring progression from school to uni to working life. I always loved economics in high school, had a really amazing economics teacher. And we actually had quite a big group of girls. I went to a Catholic girls' school and there were like 30 of us, which is, I think, more on the rare side these days because we've actually seen a decline in the study of economics, particularly in girls, but across the board as well. I think people feel like they don't really know what they can do with it. It seems quite abstract. I think people think it's boring and it's a job for the retiring white male, which is completely not true. But I think that's definitely the perception of it. And also people are fearful of the maths involved in economics. So we actually had quite a big group of girls and I really liked it. And I continued to do economics at uni. I did commerce and economics. And then I thought I'll just apply for any sort of grad job everywhere. I did a bit all banks, all investment banks, some economic groups as well. And I got a job at CBA as part of an institutional banking rotation as a grad. And then I moved into the economics team from there once I had found them and I was like, yeah, I want to do a rotation. Yeah.
Oh, brilliant. So you always just stumbled into that lane and found it vibed with you largely through your
basically. Yeah.
What do you enjoy most about distilling that sort of technical stuff into plain English?
I feel sometimes when I read other economists' notes, sometimes I think I don't even understand what they're talking about. It's so technical. It seems so high level. And I think people disengage when they're like, okay, the economy's done this, but who cares? So what? What does it mean for me? And that's what matters at the end of the day. And I think people can't often find the connection in the dots between all these different indicators that we have and actually how does it impact your day-to-day life. And that's what I think economists should be doing more is trying to help people connect the dots and get people to understand how economics impacts you every single day. So that was our aim with trying to distill myths and trying to get people actually to follow what's going on in the economy, be more engaged in the economic debate. And I think that does make you a better investor. It helps you to build your wealth. It just helps you to feel more confident about your own finances as well. And that's really important.
Yeah, good. Connecting the dots. I like that. Now, I feel like there's a lot of noise around at the moment with everything going on from budgets through to geopolitical stuff. And we want to help listeners connect the dots, to use your term, and distill down what actually matters, not just what the headlines say.
Yeah.
So if you had to describe particularly the Australian economy right now in plain English, what's the vibe? How are we looking?
Yeah, this is actually the question that I get the most when people say, what do you do for work? And I say, I'm an economist. Oh, okay. So how's the economy doing? And it's so nuanced and depends what particular sector you're talking about. I would say, I think there's a lot of fear at the moment because of everything that you just said, basically, and people feel like they're not really in control of what's going on, and they're worried that their money is going to vanish overnight or maybe even in a year's time. And there's just this really built up concern that we might be heading down the path of a downturn. I think people always worry that we're going to go down the path of some economic catastrophe because it's quite, I think it's not necessarily easy to see us going down that path. I think it's just that sometimes it's easier to be more negative than it is just to think, oh, things will just carry on as they are and we'll just continue it. Whatever we're doing right now, it's also maybe a bit less exciting to think that things will just carry on. But fundamentally, Australia is still in a really good shape overall. Our economy is actually doing pretty well. We have a very stable labour market. We have a low unemployment rate. And when we think about future employment growth, it's still looking pretty good. And we can track that through various different indicators. But I think the unemployment rate is going to stay relatively low here. That's critical because that means people will stay employed. People can pay mortgages. People can spend on goods and services. Our economy can remain vibrant. So I think that's a really good sign for consumers. What is a problem is inflation. We had done a really good job in bringing inflation down in 2025. And then at the back end of last year, we saw it creeping back up again. But the reason it's creeping back up again is basically because our economy is running at pretty solid levels and people are spending. And we are in the situation where, because we've had low productivity growth for a while, basically the supply of our economy is not as high as it once was. So we can't grow very strongly without generating inflation. We don't have enough resources in terms of people or the ability to produce that much without generating inflation. And that's where productivity comes into it. To be able to produce more without generating inflation, we need to see higher levels of productivity growth, basically. So there's reasons to be optimistic, I think. Sorry to cut you off. The geopolitical environment is an issue for the world. Australia, I guess, people are worried about it more because we rely so much on refined petrol. But we've had 3 months where the Strait of Hormuz has been closed and oil prices, of course, have increased, but it's not at catastrophic levels. So I think we've been able to offset a lot of the disruption to oil flows through like the Saudi Arabia pipeline or using floating oil facilities. The oil market was technically oversupplied before we went into the conflict too. So we do have these offsets. Of course, the longer it goes on, the more of a problem it becomes. But it's in basically the US and Iran's interest to get some sort of a deal across the board within the next few months. So I think the situation does get resolved ultimately. I can understand why people are feeling concerned about it.
Yeah. So if you were to just, for someone that's like really busy, finds this stuff, it's like speaking another language.
Yeah.
What would you say the 2 or 3 economic indicators that matter right now for us are?
Watching the share market, I think that gives you a good sign about investor sentiment. So when there's a lot of uneasiness, concern, share markets don't tend to do so well, either domestically or globally. I think the US is a better global leading indicator compared to Australia because we have a share market that's very concentrated in mining and banks. And the US share market is concentrated too in tech, but sort of tech is on a tear and, you can't, I don't think that there's genuine reasons to think that tech is going to go through a crash in the next year or two. But our concentration risks are more of an issue for our share market also because we have very slow profit growth in Australia compared to globally. So watching global share markets is important. Focusing on what the RBA is going to do, which is mainly looking at the monthly inflation data, which we get, I think that's sort of key. I would focus on those 2 things.
Okay. The share market, inflation, these types of things.
Yeah.
So I just want to come back to this concept of productivity, Diana. It feels like one of those buzzwords that gets thrown around by whether a politician or an economist. What does it actually mean for the layperson listening along right now? Yeah. Why is that important?
Yeah. So you don't see productivity every day, but it's important. Firstly, let's just look at what it is. So productivity is getting more output basically from the same level of inputs. And most people would think, oh, that means reducing the number of people that you have. And in some cases that was true. We've moved from a very manufacturing intensive economy like Australia was, and a lot of other advanced Western countries were, to more of a services-based economy, and we replaced people on the manufacturing lines with machinery and automation. That was the first wave of the automation revolution. So that was a productivity improvement, but it mostly comes from small changes. A lot of regulation at the moment, I'd say, is a big driver of productivity growth, particularly when you think about things like construction and all the regulatory burdens that construction companies have to go through to be able to put up an apartment building or to be able to build a house. So it's those sorts of little things that make a change in productivity growth. In Australia, we have had in the past few years a labour market which has really been driven by what we call the non-market sector. So a lot of it is public sector jobs, but not technically everything.
Yep.
It's healthcare, social assistance, it's education, public administration. Not everyone who works in education or in the health sector is employed by the public sector, but a lot of that money is derived by public sector type of funds. And that area has had low productivity growth, but it always has. And the issue in recent years has been that because it's generated so much more growth for Australia and it already had low productivity growth because of how it's measured, it's had more of an outsized impact, basically. And when you account for measurement issues in things like healthcare, for example, how does a doctor become more productive? Is it seeing more patients? That's not necessarily better for the patients. So when you take those things into account, productivity growth does look a lot better in those sectors, but it's not as high as we'd like it to be. But productivity growth has also been a bit sluggish in the private sector. So the government's trying to address these issues with, there have been a few announcements since the productivity reform roundtable, but again, they're not necessarily, I'm not looking for a big policy announcement to improve productivity growth, but they're small things, and some tax changes also help with productivity growth because it changes incentives for people and investment, but it's all around making your economy more dynamic, allowing more businesses to be able to create and innovate. So creating that type of dynamism in the business sector that you would want to see with more innovation and regulation. It's important because productivity growth is important because it's basically the long-term driver of living standards. If you just chart people's household incomes, which is your living standards, and productivity growth, the two line up. So that's why it's important that we keep on making our economy more productive, because it does help with increasing living standards. And it's not about reducing headcount and making people redundant and putting a machine in. It's not about that. It's just about changing the structures or how we've been doing certain things to be able to produce more.
Yeah, okay. That's great insight on productivity and what it means and why it's important. So it's our living standards are tied to it effectively. So in your eyes, this productivity conversation, is this a real concerning issue or is it a bit overcooked?
It is a concerning issue, and sometimes why have we had such a focus on it recently? I think it's because sometimes you have a few quarters worth of data where things aren't, the productivity numbers aren't looking too good. And you sort of think, oh, we can look through this. It was a COVID impact or something strange is going on. But it's basically been years and years of this slow productivity growth. We used to run annual productivity growth had averaged 1.5% in Australia. So we had 1.5% growth from productivity. We had a population that was growing by 1 or 1.5%, and that gets you to about 3% GDP growth every year. That's pretty good. Now, at the moment, we have productivity growth that's about 0.5%, if not less. And the population is still growing at about 1.5%. So our economy can only grow at 2%, basically. That is our productive capacity. If we grow at any more than that, we generally tend to get inflation, which is what happened last year.
Okay. So in your view, government policymakers, do you feel like they're doing enough to address productivity?
I think that they've started, but we're probably only at the very start of this. Hopefully we'll see more tinkering in the next few years around working with the states a bit closer to increase housing supply and doing other measures around, for example, lifting education standards, making the construction sector more productive, reducing the regulatory burden of services firms. Hopefully we'll see some more changes with that. But again, it's not something that can be done quickly. These small piecemeal type of measures that can help.
A bit of a lag for it to start to take effect. And if you were a treasurer for a week, if I just gave you that power, what sort of things would you particularly be doing, Diana? Not to pin you to the wall, but just interested to hear your thoughts.
I think in the long term, we need to reduce our personal income tax rates, but we can't, that sounds really nice. Reduce taxes for everyone, but you have to pay for that with something. It doesn't just come out of the sky, and you can't just print money to do that. So to do that, I think to make our tax system better is to reduce people's personal income tax rates or to index the tax brackets with inflation, because that would reduce bracket creep. Which is basically your income going up every single year and you're moving up into higher tax brackets. But then to offset that by increasing the GST. We need to increase the GST fundamentally because we want to reduce the burden that people have with paying wages, so with wage taxation, but we still need to get revenue from somewhere. And our GST relative to other countries, if you think about things like a sales tax, it is quite low. It's reducing as a share of a tax on goods that we're purchasing. So it was always meant to cover a larger share of goods, but because we've changed how we're spending more on services, the level of GST that the government's getting is actually reducing as a share of what it used to be. So I think that would help make the economy more dynamic in the future and help people to feel less of a strain from taxes, and also help some of the capital gains tax debate that we've had recently.
Let's vote you in. So not a conversation I'm having at the minute that doesn't reflect on the budget from a couple of weeks back. And typically I find when we hear budget, people just mentally check out, but not so much this time. Everyone's got some views or some expert opinions. So I suppose in simple terms, just from what you've taken out, I know that you mentioned to me offline before, there's probably more of an accountant's budget, but just what were the 2 or 3 biggest things that you found in this year's budget that are worth consideration?
So the capital gains and negative gearing changes were the 2 biggest things in there. They were flagged beforehand, but I guess we didn't know precisely what it would entail. And the move for the capital gains system to go back to an inflation indexation system, I think, is a big change that people have to get used to. We don't know what the legislation will fundamentally look like because it'll be pushed through, I think, in a few weeks, but it looks like there will be potentially some tinkering to the changes there. But those are the 2 things that people are most concerned about, because ultimately it's a change in taxes. I think people are feeling like the average person's going to be paying a higher rate of tax when personal income tax rates are already very high. And that's what I think is giving people the most amount of angst. Yeah.
So the net gearing changes and the general discount removal. I think it's also just worth noting on, if you read the budget papers, it says for consultation, and we do still need to see this stuff getting legislated. You're already seeing some noise that maybe things might be discussed or watered down a bit.
So tech and startups were already noted in the budget papers as being under consultation, because the CGT change, the capital gains tax change, moving to an inflation indexation system would be quite negative for a business that starts at 0, because you have nothing to index your cost base with. So if you have a really big capital gain in that business and it grows a lot, you'll be paying a high amount of tax if you sell that business. Not that you shouldn't not pay tax on big gains. I think that this is also the reality that people need to face, is that if you've made a really big gain that's above inflation, or even a big nominal gain, you need to pay some sort of tax on it. But I guess the problem is that it's a disincentive for businesses to grow and start and invest. So that was always noted as that would be under consultation. Small businesses with a revenue under turnover of under $2 million were exempt from the CGT changes, so that doesn't impact you. But I guess people are worried that if I'm a small business and I'm going to grow into a larger business, or a medium business, this is going to hurt me. I think the tech and startup sector will see some more announcements on that, what that's actually going to look like. And even for small businesses, maybe there'll be something else in there, in terms of if you're going to grow to a medium or a larger business, what it means. But the amount of backlash, I think that Australians feel very strongly, we feel like we've been lied to. I don't necessarily think that the government's lied to us, but there's obviously a lot of that concern in the news in the last few weeks. Interestingly, the consumer sentiment figures showed that young people actually took a more positive view of this budget. And that's how it was certainly framed, is that it was a budget for intergenerational fairness. And even though the backlash in the news has been that this is not going to help young people, I think the reality is that inequality around the world has been going up over time, mainly due to rising wealth prices and asset prices. And this goes a little bit of the way to address some of those challenges. But in the process, of course, people are going to get taxed more, and that always hurts.
Yeah. And I suppose it just means that you need to be more strategic when you're making investment decisions. The vehicles you're using, the structures you're using, getting good advice can certainly support that.
Totally.
You shouldn't just sit on the sidelines and not participate.
Yeah.
You still want to grow. And so with these changes, you just alluded to it there, it was seen as a budget to help younger people. And that's in the sense of affordability for housing. That's a concern for me with my kids down the line. I'm sure you're the same. Do you feel these changes that are being proposed actually impact housing affordability, or is that a bit oversold?
I think they probably do help at the margin. The issue with affordability is fundamentally two things. One, we don't build enough at the moment to keep up with demand, and we already have a shortage of homes, so we really need to be building a lot more. And the budget addressed that a little bit, but it would have been good to see more on that side, on the supply side. The second issue is that home price growth has been running above incomes in Australia for such a long time. And I think that the budget did start to address that, because we are going to see, I think, lower home price growth as a result of these changes. And that should help affordability for people. Even right now, getting into the market, maybe prices are a little bit softer than where they would have been. And in 10, 20 years' time, at least we're not going down the path that we were on before, whereas we're basically just, Australia's continuing to get more unaffordable every single year. And I don't think that that was the path that we should have gone down for the long term. So I think that it was the right move to help affordability. The issue is that people have is around the capital gains tax changes, including shares. So if people want to build their wealth, they feel like maybe they can't as much. I still think that you can, because you're not getting taxed on all of your gain. You're getting taxed on the real gain. And it doesn't necessarily always work out worse for you under the new system versus the old system. But as you said, it's good to be advised. That sort of, it will push people more into that. I think it also encourages more longer term investment, because inflation generally tends to be higher over the long term rather than short term selling within a 3 to 5 year window. I think it encourages people to hold on to assets, and that's not necessarily bad.
Yep. Now, Diana, I was talking to some clients yesterday, and I name dropped that I was going to be having a chat with you today. And I said, is there anything you'd like me to ask Diana while I've got hold of her? And the clear one was around interest rates. So let's talk rates. The RBA did jack them up again in May for the third one this year, on the back of a couple of reductions last year. What's the messaging behind that move to increase in May and so forth?
It's basically that inflation's too high in Australia, which goes back, I think, to our first point with around that we have an economy that can't really grow above 2% per annum at the moment. And at the back end of last year, we had GDP growth that was pretty good, running at 2.2 or 2.3% or so. And we basically got a tick up in inflation again. And it's in services, it's in goods. I'd say it's across the board that we're seeing inflation still remaining quite elevated, probably more in services, particularly in essential things. Why their price is rising, it's mostly due to wages as well as products, but wages are a huge part of that. And the labour market's been so strong that you can understand why wages growth has still been elevated, because people can ask for higher wages because they think I can just go and move to another job and my employer will give me more money if I decide to stay. So it's mostly to do with that. Of course, high oil price and the flow through of that doesn't help, but it's not the main reason why the RBA is raising rates. It's mainly due to those domestic issues that were already there before. I think there is the risk of another rate rise, maybe in August. Hard to see one happening in June at the next meeting, but we get another set of inflation figures before the August meeting, and I think that they're still going to be quite elevated, and it's just not in the RBA's appetite to see any elevated inflation at this stage.
Okay, so base case pathway is next set of data comes prior to August. Unlikely that it'll be the main villain being CPI will be rectified by then, so we're probably likely to consider a rate rise. And so in your view, the oil price issue, Strait of Hormuz, chokehold, that sort of stuff is not the main driver of this inflationary uplift. Yeah, okay.
Yeah, absolutely.
Yeah. Okay, great. So then what are the main things we're looking at when it comes to inflation and interest? Is it wages, unemployment?
So looking ahead, wages growth looks to have peaked, but it's still elevated. it's still running at over 3% per year, which is still pretty high. And we get the minimum wage decision. Yep. The Fair Work Commission will come out with that. And that looks like it could be another hefty one. So that doesn't help as well in terms of lifting average wages growth, because it does tie in award wages, it ties in enterprise bargaining agreements as well. So I think wages growth is still going to look a little bit high. Parts of the housing market, like rents, construction costs, are still elevated as well. Other parts of services like medical costs, I think that there are some structural things in there that's going to keep price a little bit elevated. So basically, our view is that inflation does stay a little bit elevated, closer to the 3% bracket than we'd like it to be. We really are targeting 2.5%. So it is hard to see rates coming down significantly. We did think maybe we'll get some rate cuts next year if the RBA goes a little bit too hard and raises rates too much, and we get a bit of a negative impact to growth from high oil prices, because usually when oil prices rise a lot, you do tend to see demand come off across the board. We're not really seeing that as much this time around. It looks like economy is quite resilient to high oil prices, but there's certainly a risk. So there is a risk that we may have to get some rate cuts next year, but I'm not going to be betting on that at this stage. I think inflation still remains a little bit elevated in Australia, but hopefully we only get one more rate rise, and that's enough to keep inflation from increasing more. But I would expect inflation to remain at about 3% in the next 12 months, which is still above the RBA's 2.5% forecast. So maybe we actually get 2 more rate hikes from here. So we've got a cash rate that's at 4.6% at the moment. Once you get above 5%, I think that's when you're going to see more of the negative growth impacts to the economy from higher interest rates.
Okay. Sounds like there's a fair bit that needs to happen before we start talking about cutting rates.
Yeah, that's right. Yeah.
Great. Now, I tune into your monthly newsletter, Econo Insights. Is that right? Is that what we call it? Yep. Great. And in there, you've been a bit of dialogue about the Strait of Hormuz. Why in particular do you think we should be particularly interested about a strait halfway across the world?
Yeah.
Why is it particularly interesting?
So it accounts for about 20% of oil supply, the number of tankers that flow through there. It's because that Middle Eastern region produces a lot of the world's oil, and it has to flow through the strait. It can go through a pipeline through Saudi Arabia as well. But for Australian oil, a lot of what we get from overseas, from Singapore, basically comes through there. That's why it's a key global choke point, as you said before. And that's why we care about how much oil is flowing through there. We've seen a little bit more oil coming through in the last few weeks, but it's nowhere near back to where it was before the conflict started. Australia imports most of its refined oil. So if there's no oil flowing through for Singapore to refine, then we're stuck because we don't have our own refining facilities here. And Australia uses a lot of oil, particularly diesel, for our farming sector, agriculture, not just the usual household type of thing, and businesses use it too for manufacturing, etc. So that's why Australia is probably a bit more reliant on it, because we do import most of our refined materials, and that's why we focus on it. I've been surprised actually at the resilience of the global economy to high oil prices, and maybe we're able to offset more oil than we had expected, and I think also because the market was a bit oversupplied beforehand.
Okay. Yeah, more reserves. So like back earlier, you said the share market is a good proxy for how the world is going, and what we see is generally the share market climbs this wall of worry concept. Might be a little bit off base here, but I do recall seeing a stat that since sort of 1986, 1987, I think this is the 8th time we've had an oil spike like this of 20% in 2 days. And about 6 of them have been tied to a Middle East conflict, and one to the Russia-Ukraine one, and then the other one was the GFC, which is more than a one-speed event. So in your view, do you think that what we're seeing is markets climbing this wall of worry still? Do you think that maybe it's underestimating the risk somewhat, or is it appropriately priced?
It's a really good question. I would have thought if the market was to freak out about this, it would have done so already. So there are probably a few offsets. I think the market's expecting Trump to taco, so Trump always chickens out. They think that he'll just make a deal and say it's the best deal in the world and I'm the best negotiator in the world, because it's not really in his interests to start another war. to have prices increase a lot for consumers. The US has a midterm election later this year, and the Republicans are at a huge risk, and they probably will lose the House in terms of the number of seats there, and that will make it harder for them to pass policies in their last 2 years. So this is why I don't think it's in the US's interest to keep this going for too long. And why that's why the market agrees with that view.
I understand.
And I think also if we didn't have the boom in AI that we've had, we wouldn't have had such a strong response in terms of markets lifting up again. They've looked through, initially we had a few percent drop, but they've looked through that. Profit reporting season was really good. We haven't seen much of a negative impact to the growth story. We've been able to offset some of that oil that was flowing through the strait. So maybe we can just deal with a 5 to 10% decline in oil supply across the world, and we just have to deal with high prices. But the world carries on, and maybe it's less of a big deal than we thought. Also, the global economy is less oil intensive than it was a few decades ago. We use less oil for every stage of production because we're more services based, and I think that's probably the major reason. We just don't need as much oil as we once did in terms of our processes. So there are probably more offsets than we expected at the beginning of this, and that's why the markets look through a lot of this noise.
Yeah, those midterms for Donald are definitely on everyone's mind, and my understanding is the sentiment for what he's doing over there is pretty low too. So
yes,
you might be right about your taco comments. So, so what do you see as the biggest headwinds here for global markets? Is there any particular things that you'd be keeping an eye on?
We do need to get a deal soon. If we don't see one on Hormuz, that throws up more challenges for sure. Big question marks over whether tech can keep performing at its current rate. The CapEx plans for the major US tech companies is close to $1 trillion for next year. Can that momentum keep going? Are we going to reap the benefits, the productivity benefits from AI? I think we need to see more evidence of that. Concern over whether the global data is going to start softening due to high oil prices. And we've seen a little bit of it with business surveys, particularly for the services sector, deteriorate a little bit. It would be bad to see if that extended to manufacturing and if that got even worse for services. Whether inflation continues to keep creeping up and that will impinge central banks' efforts. We might have to see more rate hikes. The share market never likes the idea of rate hikes, so that's also a problem. Those are the key things that I'm watching.
Key headwinds, yeah. And so if you were chatting to a long-term investor, it could be someone inside the family or at a barbecue, and they're feeling a bit twitchy, what would you want them to remember right now?
I'd say I'd ask them what they're invested in firstly, and to make sure that they're comfortable with that, and to remind that volatility is very normal in markets. It's good to stay invested for the long term. If you are a retiree who is in the midst of retirement, you want to have a few years worth of cash buffers in there to account for the volatility, and the geopolitical noise is not going to go away without the Don in power. So I think because we've moved from a unipolar to a multipolar world, so I think that these global different spheres of influence continue to be really important, and that will drive more volatility in markets. So I would say you have to get used to that if you want to. But if you want to take the risk, global equities, I think, still look like a good place to park your money and to have some offsets in some defensives. I personally think global bonds are a less good diversified these days, but that's just my view. But I would just say to keep in mind that volatility is normal, and if you're invested in shares and there's an announcement about a war or something and shares fall 10%, it's too late to do anything by then. Don't take your money out when they've fallen by 10%. It's better just to stay invested, because unless we are going through a really genuine deep recession and we have another GFC style moment, geopolitical events tend to see markets go up in a year's time. So sometimes it's better to look through the noise, but it does depend on what's driving the volatility at the time. Brilliant
practical insights there, and basically think about your runway, think about what your objectives are, and always, advice in that regard. So that's brilliant. Thanks for giving us an overarching insight on all these buzzwords with the budget and productivity and what it means for our economy. It's very helpful, Diana.
Thank you.
How can people connect or understand more about what you do?
So you can follow us on social media. We are Econosites on Instagram, TikTok, LinkedIn. If you want to subscribe to our notes, I guess reach out to you, John, and you can put us in touch, but you can subscribe to our notes. We write a few things a week based on data and weekly updates and things like that.
Yeah, brilliant. Thanks, Diana. It's always a pleasure and never a chore to chat to you. It's really helpful. And yeah, thanks for offering up your time.
Thanks so much.
There you have it. We just got stuck into so much there with Diana. Particularly, she managed to make things like markets, rates, inflation, productivity, and geopolitical concepts feel slightly less terrifying, which is awesome, and no small feat. If you enjoyed this episode, send it to a mate who needs the economics explained without the jargon and corporate waffle. And if you want to help organising your money so you can grow, spend, and save it with confidence, get in touch with us at Apex Advice. Give us a like and a rating. Thanks again for tuning in. I really appreciate your time. Cheers. Stay beautiful. Bye.